Marvell Technology is currently executing one of the most brilliant strategic pivots we've ever seen in the semiconductor space. They are absolutely dominating the massive expansion in AI data infrastructure right now. But there is a catch, a massive one. The market has noticed. In fact, the market has noticed so much that Marvell stock is currently trading at a staggering valuation multiple. We're talking about a premium that implies investors are pricing in a flawless multi-year execution curve. And mathematically speaking, that level of perfection might be almost impossible to sustain over the long run.
And here is the exact number that proves the point. 52x. That is Marvell's forward price-to-earnings multiple as of late August 2026. The stock actually saw a massive 29% pre-earnings run-up in August alone. So we're left with this incredible core tension for investors. On one hand, you have a phenomenal, high-quality business executing at the highest level. On the other hand, you have a valuation that leaves absolutely zero room for error. So what actually happens when an unstoppable AI growth engine meets the harsh gravity of multiple compression? Let's find out.
To really understand why the market is paying such a massive premium for Marvell today, we first have to look at what the business actually does and how drastically that has changed. If you rewind a decade ago, Marvell was heavily exposed to legacy consumer and PC-centric storage markets. It wasn't exactly the most glamorous place to be. But over the last 10 years, management has orchestrated an absolute masterclass in structural transformation. Today, they've completely shed that legacy baggage. Marvell operates as a fabless designer of high-performance semiconductor solutions. They have pivoted their entire identity to become a pure-play data infrastructure giant. And that pivot is the true economic engine driving this business.
Just look at how thoroughly this strategy has paid off. In their Q2 fiscal 2027 report, the revenue mix is totally unrecognizable from a few years ago. A staggering 79.3% of the business now comes purely from the hyperscale data center segment. We're talking about massive contracts driven by giants like Google, Meta, and AWS. The remaining 20.7% is basically communications and a few other legacy segments. So, when you buy Marvell today, you aren't buying a diversified legacy chipmaker. You are overwhelmingly buying a direct ticket to AI infrastructure growth. And here's why their technology specifically matters so much right now. As these massive machine learning models scale up, they are running headfirst into the physical limits of traditional processors. The biggest bottleneck holding back AI today isn't necessarily compute power, it's connectivity. It's the physical challenge of getting massive amounts of data to move fast enough between tens of thousands of GPUs. That is exactly where Marvell steps in. They solve this through proprietary tech like SerDes, which, to put it simply, is the intellectual property that serializes data so it can travel at literal light speed across optical networks. They also specialize in advanced 2.5D and 3D packaging. To put that into perspective, think of traditional chip design like sprawling suburban neighborhoods, while Marvell's 3D packaging is like building a dense, towering skyscraper. By stacking chiplets vertically or packing them incredibly close together, data has to travel much shorter distances. That dramatically speeds up processing times while massively cutting down on power consumption. In short, Marvell has made itself the essential plumber of the entire AI revolution.
So, the narrative sounds great, right? But the crucial question is this underlying business actually delivering the numbers to back up the AI hype? The answer is a definitive yes. On August 27, 2026, Marvell dropped their Q2 fiscal year 2027 results, and honestly, it was a total blowout. Total net revenue surged 37% year-over-year, hitting $2.739 billion. That easily crushed the consensus estimate of $2.71 billion. And that data center segment we just talked about, it rocketed up 46%. This kind of explosive top-line growth is driving some incredible operational leverage for the company. Non-GAAP operating margins expanded to an impressive 36.6%, pulling non-GAAP EPS up to 94 cents, which beat Wall Street's expectations. But what really poured gasoline on the fire for the stock was management's forward-looking commentary. They actually raised their revenue outlook for fiscal 2027 and 2028 because the AI bookings across custom silicon and high-speed optics are just remarkably strong. The market reacted powerfully to this beat, cementing that 29% pre-earnings rally. And by the way, if this kind of research-first, deep dive analysis is your thing, you'll probably want to subscribe.
Looking ahead, the runway for this growth is just staggering. Management projects that their total addressable market, or TAM, for data center solutions will balloon to $75 billion by calendar year 2028. That represents a 29% compound annual growth rate starting from 2023, and within that massive $75 billion pie, custom compute, specifically application-specific integrated circuits, or ASICs, makes up a $43 billion slice. Right now, Marvell is aggressively targeting a complete doubling of its custom compute market share. They want to go from roughly 10% share back in 2023 up to 20% by 2028. And their strategic wedge to do this is pretty brilliant. They champion open standards. They'd offer aggressive dual sourcing options for hyperscalers who are completely terrified of being locked into a single vendor, and they tightly integrate their world-class optics directly with the custom silicon. It is an incredibly smart playbook, but getting to that 20% mark isn't going to be easy.
Because standing in their way is the 800-pound gorilla of the networking world. This brings us to the central conflict of the Marvell story and the main thing the market is worried about.
While the AI infrastructure TAM is undeniably massive, this market is not some friendly free-for-all. It operates as a brutally tight, fiercely competitive duopoly. And Broadcom is the deeply entrenched incumbent here. They currently hold a dominant 70% share of the custom AI design services market, boasting massive legacy partnerships with heavyweights like Google, Meta, and OpenAI. Marvell is the structural number 2 player, currently sitting around that 20 to 25% market share mark. And let me tell you, Broadcom is a terrifying competitor to go up against. Because of Broadcom's massive, sprawling scale and gross margins that approach 79%, they have an immense financial war chest. Those sky-high margins allow Broadcom to absorb absolute massive R&D costs, and more importantly, they can offer incredibly aggressive pricing just to box competitors out and secure next-generation socket wins. This dynamic constantly threatens to squeeze Marvell out of crucial, multi-year R&D cycles. It is a persistent, structural threat to Marvell's ambition of expanding their market share.
However, Marvell is actively proving that they can win these critical battles against Broadcom. In August of 2026, Marvell secured a landmark commercial agreement with Google to co-develop custom semiconductor products across the entire Google Tensor Processing Unit, or TPU, ecosystem. Now, this was not just a standard run-of-the-mill vendor contract. The deal includes performance-vested warrants for up to nearly 59 million Marvell shares, and those warrants are tied directly to revenue tranches. What that does is create an incredibly powerful incentive program, one that is tied to an implied $120 billion revenue ceiling all the way through fiscal 2033. Just let the magnitude of that number sink in for a second. This deal is totally game-changing for the Marvell thesis. It completely validates Marvell's ultra-advanced technology at the highest levels, and it provides undeniable hard proof that they are successfully ripping lucrative dual-source market share away from accounts that Broadcom previously monopolized.
So, with these massive wins on the board, let's step back and look at the underlying qualitative health of the business. Does the foundation of this company actually justify the massive premium the market is placing on it?
The AI narrative is clearly strong, the TAM is expanding, and they are landing the necessary hyperscaler deals. When we actually score Marvell's fundamental business quality, they come out looking excellent, with a very strong blended total of 8.2 out of 10. Management scores a solid 8 out of 10. And that's largely because they have a proven multi-year track record of perfectly executing one of the hardest strategic pivots in tech history, moving decisively away from legacy storage and planting their flag right in the heart of the AI boom. Their capital allocation has also been hyper-focused and heavily disciplined. They strategically divested their legacy automotive business to Infineon for $2.5 billion in cash, and then immediately turned around and used that capital to fund high-priority AI connectivity acquisitions. They bought Celestial AI to secure vital silicon photonics technology, and they snapped up XConn Technologies. Financially, the company is essentially bulletproof, scoring a 9 out of 10. They're sitting on $3.93 billion in cash against $4.47 billion in total debt, which leaves them with a very conservative net debt to EBITDA ratio of negative 1.72. Combine that with a pristine 9 out of 10 for their secular AI growth outlook, and what you have is a wonderfully managed, exceptionally high-quality enterprise.
Now, all of the research behind this video was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems for under-the-radar names with asymmetric upside; and dividend hunters, focusing on durable income with the fundamentals to back it up. Premium also includes Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or just access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's get into the mathematical reality check.
We've established that the business is fantastic, but how does that 52x multiple hold up over a 5-year horizon through fiscal year 2031? Let's build out the scenario framework.
But first, before we break down the numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
All right, we are starting from a year zero share price of $244.18. Let's focus our attention on the base case, to which this framework assigns a 60% probability. This scenario assumes that the operational logic of the AI infrastructure rollout remains exactly on track. For Marvell to hit this base case, they have to execute beautifully over the next 5 years. They must successfully ramp up those Google TPU sockets, they have to maintain their critical design positions with AWS and Microsoft, and they have to ensure that demand for their 800G and 1.6T optical transceivers stays robust. If they pull all of that off operationally, this results in year 5 revenue nearly doubling to $25.5 billion, with their non-GAAP operating margin expanding to a highly impressive 38.0%. This pushes diluted EPS up to $8.74. But here is the catch. As the business scales into a massive $25 billion giant, its growth rate is inevitably going to slow down. It's just the law of large numbers. And the market simply will not pay a 52x multiple for a mature, albeit successful, infrastructure company. So, our model mathematically assumes that over those 5 years, that massive multiple compresses down to a more normalized 28x exit PE.
And that brings us to the dramatic climax of this entire analysis. Under that base case, where Marvell essentially does everything right and doubles their revenue, the implied future share price in 5 years is $244.62. What does that mean for an investor today? It means over a 5-year holding period, the annualized return is practically flat at a positive 0.04%. Let that sink in for a moment. You can buy an absolutely amazing company, watch management execute the strategy perfectly, and still make zero money. The massive multiple contraction from 52x down to 28x acts like a black hole. It completely eats all of the incredible operational growth they generated. To get a decent return from today's price, you have to believe in the absolute perfection of the high case. In that scenario, they hit $34 billion in revenue and somehow managed to hold on to a premium 35x multiple, which would give you about an 11.9% annualized return. And if they stumble and hit the low case, if growth slows and the multiple collapses to 20x, you're looking at a brutal 22% annualized loss. Which means we really need to look at the downside. Because even if the base case plays out flawlessly, the return profile is challenging. But what if it doesn't play out flawlessly? What are the hidden threats that could break this thesis entirely? Marvell faces some very concrete existential risks that investors need to watch closely. The most terrifying of these is extreme customer concentration. Their custom silicon business is heavily reliant on just a handful of hyperscalers, specifically AWS, Microsoft, and Google. If any one of these cloud titans decides that standardizing on open networking is moving too slowly, and they pull their custom silicon designs entirely in-house, Marvell's long-term pipeline doesn't just shrink, it essentially collapses. Second is the massive geopolitical and supply chain vulnerability. Remember, Marvell is a fabless chipmaker. They do not manufacture a single one of their own chips. They rely entirely on external foundries, primarily TSMC over in Taiwan, for all of their most advanced wafers. With 75% of Marvell's total revenue tied to Asian operations, any major geopolitical trade disruption or military action in the Taiwan Strait is a catastrophic, thesis-breaking risk. You also have severe technological execution risks at the ultra-advanced 3nm and 2nm manufacturing nodes. At that microscopic scale, yield issues can destroy gross margins literally overnight. And finally, there's the ever-present threat we discussed earlier. Broadcom's immense pricing power squeezing them on the bottom line, combined with NVIDIA pushing proprietary networking fabrics that could completely lock out the open Ethernet standards that Marvell so heavily relies on.
So bringing it all together, here's the bottom line on Marvell. This is a structurally vital asset powering the global AI expansion. They have transformed themselves into the essential, high-quality dual-sourcing partner for custom silicon. They are legitimately challenging Broadcom's monopoly, a fact that was emphatically validated by that massive $120 billion Google warrant deal. The underlying business quality is without a doubt exceptional, but the equity itself, it is priced for absolute perfection. As the scenario framework showed us, even if management executes a flawless operational base case, the harsh gravity of multiple compression could leave investors with a basically flat return over 5 long years. The risk-reward ratio is incredibly tight right now. It really begs the ultimate question. In this current age of AI euphoria,
Are we fundamentally mispricing what perfection looks like, or is the market right to demand it? If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.